In today's video, I am going to be breaking down the differences between a mutual fund and an ETF and which is better. So first we're going to take a glance at a mutual fund that I used to hold myself, and that is the TD Dividend Income Fund. You can actually buy and sell this on the actual stock market itself, TDB 627. Now, of course, the issue with mutual funds in general is the fact that their MERs, which is the cost it takes to hold the fund, is so high. This is why I really do not like mutual funds. So, for example, for every $100 that you hold in this mutual fund, you will be paying $2.03. And of course, if you have $1,000, that'll turn into $20. If you hold $10,000, that'll turn into, of course, $203 every single year. Now keep in mind, since its inception back in 1994, it has had some fantastic growth. If you were to start with $10,000, you would currently be sitting at about $95,000 as of right now. So of course, you've had some really good growth. However, what is the dividend like? Well, it actually doesn't say on their website, but it does show you the asset mix. It shows you what sectors and what geography they invest in, which is going to be mostly Canadian, and of course, because it's Canadian, mostly financial services. The top 10 holdings is the banks, as we can see here. Brookfield Asset Management. We have another bank in Bank of Nova Scotia. We have Enbridge. Then we have CNR as well as CP. And then we have TELUS. So a pretty solid top 10 holdings. However, let's look at some potential ETFs that we could look at as an option as well. This one being BMO Growth ETF ZGRO. This is another good option. The volume is, of course, quite low. However, the MER is what we are really trying to get at, and that is the fact that it is about 10% of what the MER is of the mutual fund. Most mutual funds will have a massive MER. Most of them go between 1.5% and 4%. And what you're hoping to get with those MERs is the fact that you're hoping for bigger growth, you're hoping for larger dividends, things like that. And of course, not all mutual funds will do that. In my opinion, if you're looking at a dividend, that TD one I showed is one of my favorites. I don't hold it anymore because I can find better dividends, and as well, I can find a cheaper investment tool than that. Now, I was with that mutual fund for about a year, and it ended up to be about 2% to 2.5%. It really did depend on the month, but overall, over the year, it ended up to be about 2.25%. So it's not a massive dividend as you may hope or may think. Meanwhile, the dividend on this is very similar, and you're looking at a much cheaper MER, which means that in theory, you should have more growth in your equity that you're holding. Now, this hasn't been around since 1994, but we can look at it from the middle of about the beginning of 2019 up until now, and it rose from $30 to $38, which is about just over 20%. Now, this one does hold multiple ETFs. If you're looking to be really diverse, ZGRO is a good way to go. However, another option that you might like is a BMO Covered Call Canadian Bank ETF. Now, the reason why I say that this might be a good option, because you're getting good volume, so it's going to be easy to get in and out of. You're getting over double the amount of yield. This one also pays monthly as well, just like that mutual fund. And then also, your MER is 0.7, which is about close to 1/3 of the MER of that mutual fund. Now, this one doesn't have massive growth. It's gone from 17 to 20, which is not much of a growth. It's not huge. You're looking at maybe 10-15% per year. However, when we start looking at the actual holdings, you're going to be seeing the fact that it does hold the ETF that holds the banks evenly, as well as Bank of Montreal, CIBC, National Bank, Royal Bank of Canada, TD, Bank of Nova Scotia, and those are some of the top picks in that mutual fund anyways. Another option, which would be probably closer to that high dividend mutual fund, is iShares Canadian Select Dividend Index ETF. XDV is the ticker. And this one, again, good volume of 50,000 shares on average per day. This one's a 0.5% MER, so about a quarter of the cost of that mutual fund, and you're getting 3.5% yield, which is higher than what I was getting with that mutual fund as well. So overall, this is a very good option if you were looking at a mutual fund that was very similar. This one's rose from $22 to $29, so again, about $7, which is about 20 or so percent per year, at least 10 or 20% per year. And look at those top holdings. A bank, again, Canadian Tire, another bank, another bank, another bank, another bank, another bank. See how these mutual funds and ETFs work, and these are just comparing the similarities. So if you're currently looking to invest and you're kind of broken up between, should I invest in a mutual fund like my bank advisor is probably mentioning to me, or should I invest in ETFs, or should I just go with the market itself and try to find individual stocks? Those are three different options that you can use to invest. And when it comes down to it, basically, if you're going into a single stock, you're going to have single stock risk, which means that if that individual stock goes down, then your money goes down. While in something like a mutual fund or an ETF, you're holding multiple stocks, which means that if one goes down, it's not going to necessarily affect you. However, at the same time, with ETFs, they're going to be much cheaper than mutual funds, and they are sometimes a better option, not always. There are a few mutual funds down in the States that I've seen that have massive returns, massive dividends, and the only difference is those mutual funds that actually massively outperform are usually massively more expensive when it comes to the MER, and it's usually really only dedicated to people who have over $100,000 in the bank, or maybe over $1 million. I've even seen a few that are for people who are over $10 million. So you really also have to pay attention to things like that. Meanwhile, with ETFs, there's very few that are limited to how much you're allowed to invest. Some ETFs, yes, will say you can only invest if you put in a minimum of $10,000, but generally speaking, most ETFs are wide open. So when it comes down to it, ETFs are generally a better option than mutual funds in most cases. However, do your own research, figure out which mutual fund that you're looking at, and really dive deep into what it's holding. Because if you can find an ETF that holds the exact same, and the mutual fund is holding 4 times or costing you 4 times more money, go with the ETF. It's going to do literally the exact same thing, and it's going to cost you a lot less money, which then compounds year over year, especially if you're starting when you're 20 or 30 years old. I hope that you've enjoyed today's video. If you have, hit that like button and subscribe, and I'll see you guys again next time.